Hi, my name is Elliot Gu, and I'm co-founder and chief market strategist for the Pig vs. Bear trading service. Each month, my colleague Roger Conrad and I host a market briefing, strategy session, and Q&A for members of the Pig vs. Bear trading service. We cover our market outlook and quickly outline some of the trends and trades we're watching or looking to recommend in Pig vs. Bear when the timing is right. Well, we just hosted one of our monthly briefings this week, and today I decided to do something that we've never done before. You see, normally these briefings are only open to Pig vs. Bear members. In fact, we strictly limit the total number of new Pig vs. Bear members we accept because we want to keep these strategy sessions and the Q&A sessions that follow manageable. However, I've decided to include an 18-minute segment of this week's briefing as part of this video today. In it, I give a quick overview of my current outlook for the broader market and some of the key indicators I watch for gauging trends in the stock market and in particular the S&P 500. Warning, I didn't spend any time cleaning up the audio for this video, and my comments are unscripted because I believe it's more important to get this information out to you quickly than to try to make it look pretty or make it sound nice. So without any further ado, here's my latest take on the broader market.
Yeah, thanks, Roger. I'm going to talk first up about a little bit about the broader market and some of the trades we have that are directly or indirectly levered to the S&P 500. As many of you are well aware, the market saw a pretty much straight up advance all of 2017. The average daily close on the volatility index, the S&P volatility index or VIX, was about 11, which is the lowest in recorded history for the VIX. The VIX was created back in 1990. So, we have close to 30 years of history of the VIX, and this was the lowest calendar year close was in 2017. This year, so far in 2018, the average close in the VIX is over 20. It's about 22.5. So the VIX is roughly twice as high this year as it was last year on average so far. And that suggests that, volatility has obviously really picked up here. The thing to remember, though, is that last year was really the aberration, not this year. Last year was very unusual in terms of historical volatility as well. Only the mid-1960s rivaled 2017 for being a low volatility market. And I'll explain a little bit in a little while why that's very typical to see low volatility in the middle of an economic and market cycle. And we think that the volatility we've seen since the end of January is a reflection of our movement out of that mid-cycle and into a late-cycle bull market. This has a number of very important implications for the stock market, for the economy, and for the kinds of trades we're going to be doing in Pig versus Bear, and our bias in terms of whether we're going to be mainly wanting to trade the market from a long side, betting on higher prices, or from the short side eventually. So that's all very important. But what I want to focus on right now is that to us, we've said this in a lot of the weekly updates over the last couple of months now, really since early February, and we're sticking with it. We believe nothing's changed in terms of this basic outlook. We believe that the correction in the stock market that started on January 26 with the S&P around 2873, this is a normal correction within a bull market. It's not the beginning of a bear market. So it's a correction, not a bear market. There are a number of reasons why that's the case. I'm going to show you some of the most reliable indicators we have to suggest that's the case. But just looking at this overall chart, you'll note that yellow line on the chart. I wish it were a little easier to see actually on the screen, but you can probably see it very easily on your PDF file of the slide deck. That's the 200-day moving average for the S&P 500. It's the average closing price of the S&P over the last 200 days. This is a very commonly used technical indicator for the stock market. You'll hear about it sometimes. We heard about it a couple weeks ago, not this Monday, not yesterday, but a week ago. The S&P closed under that 200-day moving average slightly. So you heard a lot of people talking about that big break of the 200-day moving average, etc. The key thing to remember, though, is that for the broader market and for individual stocks, support and resistance levels are kind of like a cushion they're not like a hard granite countertop, right? They're like a cushion. So there's some give there. So what we saw basically, my look at this chart, is the stock market saw a big sell-off in late January and early February. The intraday low on February 9th was basically at the 200-day moving average. I believe it was actually a point or two below the 200-day, but that's a rounding error when you're talking about an index that's trading at 2600. And then we bounced all the way up until mid-March, and now we've seen a renewed sell-off over the last, let's just call it a month, since mid-March. And we retested again that 200-day moving average, which is currently right around 2596, so right under 2600. I look at that as being a typical correction in the sense that most corrections in bull markets stop within 1% or 2% of that 200-day moving average. So if the market's going to find support in a bull market, it's typically going to find it around the 200-day moving average. So far, that's been the case here. About 1/3 up to maybe 40% of all bull market corrections see the lows of that correction retested. And what we mean by that is, you can see it on this chart, the market came down sharply. On February 9th, it tested that 200-day moving average. We bounced all the way to 2,800 in mid-March. Then we came right back down and tested that just under 2,600 level where the 200-day moving average is. That's a retest. In other words, the market bounced a few percent and then came back down to about the level of that prior low. Importantly, it has not broken below that February 9th low, though the market closed at a new low. The closing low was lower in early April. It has not broken below the intraday low on February 9th. So this looks like the basic chart pattern here is a very classic correction into the 200-day moving average, followed by a retest of the lows of that correction. We've seen this a number of times. I believe 2 weeks ago in the weekly update, you can still find it on the website. I looked at the corrections over the last 3 bull markets in the final 18 months to 2 years of the last 3 bull markets. And this is pretty much a box standard stock market correction within a bull market. We do not, again, and this is important, is crucial, we do not believe it's the beginning of a bear market. One of the most important indicators to watch when assessing whether a top is the beginning of a bear market or simply a correction is market breadth. And what we mean by market breadth, of course, is not just what the overall indices are doing, but what stocks within the index are doing. As you very well know, as many of you very well know, the S&P 500 is market capitalization weighted, so is the NASDAQ. That means the largest companies in the index account for a large portion of that index's movement. So, if a company like Apple goes up, 3% in a day, that's going to have a lot bigger effect on the NASDAQ and on the S&P than, say, the 500th largest company in the S&P. The smallest company in the S&P is going to have a negligible impact. But it's very important to look what's going on beyond the surface of the market. In other words, not just the overall market itself, which really just tells you what the largest stocks in the index are doing, but also what most stocks in the index are doing. Typically, and we looked at bear markets going back about 80 years. There have been 12 over the last 80 years. That's since 1937. There have been, I suppose that's 81 years now, right? There have been 12 bear markets over this time frame, 12 bear market cycles. In most cases, the typical pattern that we could see using various different indicators is that in the final 12 to 18 months of a bull market, what you'll typically see is you'll see the market make a series of new higher highs, right? So it'll run up to a high, it'll see a correction, then it'll run up to a new high. But what you'll typically see as we reach those new higher highs is each higher high is supported by fewer stocks. So at the end of the bull market, even though the index as a whole is making new all-time highs, a lot of stocks have already broken down. And it's really just a handful of the large cap names that are supporting the market and pushing it higher. So a technical analyst or a chartist would call that deteriorating market breadth, or you might hear the term, the rally is thinning out, meaning that there are fewer stocks supporting it. This is a typical pattern at the end of a bull market and the beginning of a bear market. Virtually every time I could find in history, that's been the case. We are not yet seeing that. In fact, as you can see here, this is the cumulative advanced decline line for the New York Stock Exchange. All this is, and we use the Bloomberg one, but there are several other. I believe the Wall Street Journal produces one. Barron's, I believe, maybe produces one that you can find in the weekly issues. There are a number of different providers that offer different cumulative advanced decline line measures, but the simple long and short of it is every single day you take the number of advancers on the New York Stock Exchange, that's the number of stocks going up, and you take the number of stocks going down, you subtract the number of stocks going down from the number of stocks going up, and you add that to the previous day's total. And you're kind of keeping a cumulative count. What this means is when this number is rising, when this advanced decline line is going up, most stocks are rallying. When it's going down, most stocks are falling. What we're looking for is what's called a divergence, okay? It's a situation where the market's going up, but the advanced decline line isn't going up or is already falling. That is a big, massive, fat warning sign that says this bull market is in trouble, this rally is in trouble. We're not yet seeing that. As you can see from this chart, the advanced decline line is actually not far off its all-time high, which was set back in January. It is trading a little lower than its all-time high, but not by much. You'll also note that the early February low for the advanced decline line is much lower than the low we saw in late March and early April. And what that tells me is that even though the stock market, let me flip back to this prior slide so you can see it, even though the stock market's retesting that February 9th low, most stocks aren't following suit. So even though the market looks bad on the face of it, what you're going to hear on financial television and the media at night is, the stock market's still 10% or whatever off its highs of January 26th, 8-9% I believe at this point. The truth is that most stocks aren't falling as much as the overall market. There are a number of different ways of looking at this. It's something I probably harp on arguably too much in the weekly updates. But the Russell 2000, which is a much wider measure of stock market performance, is not down anywhere near as much as the S&P. A lot of companies, a lot of smaller companies are doing pretty well, even though the market as a whole remains well off its January 26th highs. What we'll be looking for and what you should kind of be following along with at home, and something we'll be updating for Pig versus Bear members in our weekly updates as well as in the flash alerts on the service, we'd like to see the stock market take out at least that mid-March high. So the S&P rally back up over 2,800, and for this breadth number to break out to a new all-time high. In other words, rally above that January 26, 2018 high. That would confirm to us that this is just a correction and that the stock market's likely to see higher highs over the next couple of months. That's what we're looking for. Right now, despite all the scary headlines, despite all the talk of trade wars and offices in New York, lawyers' offices in New York getting raided, and the economy, etc., the market's telling us that the message from the market itself is that this is still just a correction, and that the sell-off we saw in late March and early April, though again, there's a lot of scary talk out there, it is not even as powerful as the sell-off we saw in early February. Another indicator I look at that's kind of in the same family, if you will, is the number of 52-week lows on the NYSE. These are the number of stocks setting new 52-week or one-year lows. You can see that it spiked up to about 258, actually a little over 250 on February 6th. A few days later on February 9th, it reached a high of about 225. When we had a sell-off right at the end of February and early March, it reached a level of around 125. When we had the sell-off in late March and early April, it reached a level a little over 100. And right now we're at 31. So in other words, even though the market has had some sharp sell-offs, Again, the number of stocks making new 52-week lows has actually been shrinking on those reactions. So there's a little less power, a little less selling power behind the sell-offs in the market over the last month and a half or so. In particular, I would point you to this, again, this late March, early April rally or sell-off that we saw over the last couple of weeks, let's call it. Even though the stock market itself, the S&P 500, tested that 200-day, came very close to those lows we saw back in early February, not as many stocks are setting new 52-week lows. That tells me that the sell-offs are not as powerful as they were a couple of months ago. One thing we're watching for, I've told you what gives us confidence in the view, or gives us some conviction in the view that this is a correction, not a bear market, is that shrinking number of new lows and the higher highs in the advanced decline line. I also said we're looking for the advanced decline line to break out as the S&P 500 breaks back up over to that 2,800 level. The other thing that I'm looking at very carefully is this. This chart shows the number of 52-week highs on the New York Stock Exchange, the number of stocks setting one-year highs in price. As you can see, back at the end of the rally, it was up over 300 new stocks on the NYSE, making new 52-week highs. Obviously, when we got the sell-off in late January and early February, the number of stocks making new highs shrank sharply. However, the rallies we saw in February and March, we saw a couple of higher highs in this indicator. Since then, we have not. So what I'd like to see here is for the market to break higher, for the advanced decline line to start to break a little higher, and for 150 or more stocks on NYSE to set new 52-week highs. That'll tell me that not only is the selling power behind recent sell-offs less powerful, weaker than it was back in early February, but it'll also tell me that the punch behind rallies is more powerful than it was back in March. So this would be another indicator we'd be looking for to confirm an upside break in the S&P 500. And I think that if you look at these three last charts together, the advanced decline line, the 52-week lows and the 52-week highs, it gives you a pretty good idea how we use market breadth to time our entries into the broader market and to kind of get an idea, gauge what's going to happen to the market next over the next few weeks. We would also, our average entry point on SSO, which is the Ultra S&P 500 ETF, Exchange Traded Fund, is around 109. It's trading a little under that now, around 106, 107. We have 100 units that we've recommended in the service. We actually might think about adding to that if some of these breakouts that I just told you about happen. In other words, if we see a break higher in the S&P confirmed by the 52-week highs and the advanced decline line, we'd be tempted to add to our position in SSO. Ultimately, we still expect the S&P 500 to log a new all-time high, a significant new all-time high by this summer. I think we're going to see 3,000 on the S&P 500 at some point this year. I do think, as I said before, and I'll show you here in a second, we're nearing the end of this bull market, but just remember that last leg of the bull market's often the most powerful. In the last 1 year of the 12 bull markets since the 30s, the S&P 500 has returned 25%. In the last 2 years, it's returned 58%. So expect kind of a more powerful melt-up rally at the end of this bull market. We almost always see that. If that's the case, as I said, I tend to believe that the S&P 500 will see 3,000 at some point this year, probably in the first.
So there you have it. The headlines may be scary, but the indicators suggest the broader stock market has more upside over the next few weeks. And Roger and I have recommended trading this move using a few different exchange-traded funds, ETFs, and options recommendations in the Pig versus Bear service. However, I must warn you, this is an absolutely critical time of the market and economic cycle. As we approach the end of the long bull markets in stocks that began way back in 2009, we're looking for market volatility to remain high and for more and more stocks and sectors to begin breaking down. For investors, it's time to start planning for the coming bear market and how to protect your portfolio. The average bear market over the last 80 years lasts about 14 months, and the S&P 500 falls an average of about 35%. However, this is the best time of the cycle to be a trader. Markets move quickly in the latter stages of a bull market, offering plenty of trends to play over holding periods of 2 weeks out to a few months. And there's an old saying that stocks take the escalator up, but the elevator back down. In other words, bear markets usually unfold in more dramatic fashion than bull markets, offering traders the opportunity to make quick gains on the way down. We're so convinced that this is an ideal time to give Pig vs. Bear a test drive, we've decided to open up the service to a handful of new, risk-free trial members at the lowest price we've ever offered. Join Pig vs. Bear with their limited time Bear Market Survival VIP offer today, and you'll receive $500 off our normal subscription rate for the service. That's a membership fee of just $1,499 per year with, of course, our triple satisfaction guarantee. Guarantee number 1, sign up today and test drive Pig vs. Bear for 60 days with no risk or obligation. If you're not 100% satisfied with the service for any reason whatsoever, simply cancel your subscription at any time over the next 60 days and receive a full refund with no questions asked. Guarantee number 2, we're extending our forever guarantee for new trial members. Sign up today for $14.99 a year, the lowest rate we've ever offered, and we'll never raise your annual renewal rate for as long as you choose to remain a member. Guarantee number 3, and this is by far the best guarantee we've ever offered for Pig vs. Bear. If our Pig vs. Bear model portfolio trade recommendations do not generate enough profits for you over the next 12 months to more than pay for the subscription price, we'll extend your subscription quarter by quarter until they do. This offer is only open to those on our special Pig vs. Bear VIP list, and we simply must close this offer down for good this week. I can't promise you when or if we'll make this offer again, as we only open up Pig vs. Bear to new members a couple of times each year at most. Please tap the button below this video and use the discount code below to secure your Bear Market Survival VIP trial membership to Pig vs. Bear before it's too late. Or, should you prefer to join the service by phone, please give our customer service manager, Sherry, a call toll-free on 1-877-302-0749. That's 1-877-302-0749, and quote the discount code below this video to ensure you receive all the benefits and discounts associated with this offer. Here's to your wealth. I hope you have a great quarter in the markets. Thank you.